Illinois just became the first state in American history where more people collect government pensions than pay into them. Let that sit for a second. The math doesn't work. It can't work. And in about 18 months, the bill comes due. But Illinois isn't alone. There are 7 states right now where the numbers have crossed a threshold that economists call the point of no return. Not speculation, not fear-mongering, actual insolvency baked into budgets that are already passed and signed. And if you live in one of them, you're about to become collateral damage in the largest municipal debt crisis in American history. Here's what makes 2026 different. During the pandemic, the federal government did something unprecedented. They sent states nearly $1 trillion in emergency funding. No strings attached, no reforms required, just cash to plug holes. That money runs out in September 2026, which means states that were already bleeding before COVID, states that used federal aid to delay the inevitable, are about to go off a cliff. And unlike 2008, there's no bailout coming. The political will doesn't exist, the federal deficit is too large, and frankly, the rest of the country is tired of subsidizing failure. So what happens when a state goes bankrupt? It's not like a business. They can't liquidate. They can't restructure cleanly. What actually happens is a slow, grinding collapse, where essential services vanish, property values crater, and anyone with the means to leave does exactly that, which makes the problem worse, which accelerates the collapse. It's a death spiral, and it's already started. The 7 states. Let's go through them and pay attention to the pattern, because once you see it, you can't unsee it. Illinois, the poster child, the cautionary tale everyone points to, but nobody actually learns from. Illinois owes $317 billion in unfunded pension liabilities. Their entire state budget is $50 billion. Do that math. They would need to dedicate every dollar of revenue for 6 straight years, shut down every school, every prison, every state service, just to break even on promises already made. Obviously, that's not happening. So what is happening? They're raising taxes. But here's the sick irony. Every time they raise taxes, more high earners leave, which shrinks the tax base, which creates a bigger shortfall, which forces another tax increase. Chicago alone has lost 500,000 residents since 2000, and it's accelerating. Last year, Illinois lost more population than any state except New York and California, but those states are 5 times larger. The smart money already left. What remains is a pension system designed for a state of 13 million people, now being funded by 12.5 million and dropping. In 2026, when federal aid vanishes, Illinois will face a choice: default on pensions or cut education by 40%. There's no third option. The math doesn't allow it. New Jersey. Same disease, different symptoms. New Jersey has the second worst funded pension system in America, at just 56% funded. They owe $200 billion. But what makes Jersey special is their property taxes, highest in the nation. Average homeowner pays $9,500 a year. Some towns, it's over $20,000. And it's still not enough. Because here's what people don't understand about property taxes. They're sticky. You can't flee them without selling your house. And if everyone tries to sell at once, prices collapse, which lowers the tax base, which forces rates even higher on whoever's left. New Jersey is already seeing this. Wealthy towns in Bergen County are experiencing their first sustained population decline in 40 years. These are people who can afford to leave and are choosing to do exactly that. By 2026, New Jersey will need to either default, raise property taxes another 15 to 20%, or cut state aid to schools and municipalities. All 3 options trigger the same death spiral. Connecticut. Small state, massive problem. Connecticut made a bet in the 1990s that they could lure finance and insurance companies from New York by offering low corporate taxes. It worked for a while. Then 2008 happened, then remote work happened, and suddenly all those companies realized they didn't need to be in Connecticut at all. General Electric left, Aetna left, Alexion Pharmaceuticals left. What remained was a tax base built for an economy that no longer exists, and pension obligations designed for revenue that's never coming back. Connecticut's per capita debt is the highest in America, higher than California, higher than New York, $26,000 for every man, woman, and child. And their population is shrinking, slowly at first, then all at once. Last year, they lost 0.9% of their residents. Doesn't sound like much until you realize that's the 5th straight year of decline. In 2026, Connecticut faces the same impossible choice as Illinois: default or devastate services. There's already talk of merging towns to cut costs. That's not reform, that's triage. New York, the big one, the one nobody wants to admit is in trouble, because if New York falls, it takes a chunk of the national economy with it. New York's state and local debt is $450 billion. Their pension system is $56 billion underfunded, and that's using optimistic assumptions about market returns that haven't materialized in a decade. But here's what makes New York truly dangerous. Their revenue model is entirely dependent on a small number of ultra-high earners. The top 1% of New York taxpayers pay 46% of all state income tax. The top 5% pay 65%. During COVID, a bunch of them left. Hedge funds moved to Florida, tech executives moved to Texas, even the mayor of Miami started publicly trolling New York, inviting finance workers to flee. And they did. New York lost $25 billion in taxable income between 2020 and 2023. Not revenue, taxable income. The tax revenue lost was around $2 billion annually. Now here's the uncomfortable question. What happens if another 5% leave? The entire budget implodes. You can't replace those earners. They don't exist in sufficient numbers, which means you either cut services or raise taxes on the remaining high earners, which pushes more of them out. It's the same death spiral as Illinois, just bigger and louder. In 2026, when federal aid ends, New York will lose about $9 billion in revenue that was propping up Medicaid, schools, and transit. The subway system alone is running a $3 billion deficit. There's no plan, just hope that tax revenue spontaneously recovers. That's not a strategy, that's a prayer. California, the golden state with tarnished books. California's budget is a magic trick. Every year they project massive surpluses, every year they spend like those surpluses are guaranteed, and every year they end up with shortfalls. Right now, California is facing a $68 billion deficit. That's larger than the entire budget of most states. How did this happen? Capital gains tax. California relies on taxing stock options, IPOs, and investment income from Silicon Valley. When tech booms, California's budget explodes with revenue. When tech slumps, the budget collapses. Last year, capital gains tax revenue dropped by 45%. The state went from projected surplus to massive deficit in one fiscal quarter. And the tech boom isn't coming back anytime soon. AI isn't creating IPOs, it's creating efficiency, which means fewer workers and less taxable income. Meanwhile, California has the largest unfunded pension liability in the country, $200 billion for state workers alone. Add in local pensions and you're over $500 billion. By 2026, California will need to make cuts so deep that even progressive lawmakers are privately discussing which social programs to abandon, not reduce, abandon. The wildfire insurance market has already collapsed. State-backed insurance is now the only option in large parts of the state, and it's woefully underfunded. When the federal money runs out, California faces a reckoning between its progressive policy ambitions and mathematical reality. One of them has to give. Hawaii, the forgotten crisis. Hawaii's economy is a house of cards built on tourism and military spending. Both are contracting. Tourism hasn't recovered to pre-COVID levels and likely never will. Remote work killed the business traveler. Maui's wildfires devastated infrastructure, and locals have grown increasingly hostile to tourists, which creates a feedback loop. Meanwhile, Hawaii has massive pension and healthcare obligations for state workers. The per capita cost is staggering. because Hawaii has one of the oldest state workforces in America. But here's the real problem. Hawaii can't compete for revenue. The cost of living is so high that they're losing young workers to the mainland. The people moving in are retirees who consume services but don't generate income tax. It's a demographic time bomb. In 2026, Hawaii will lose federal pandemic funding while facing increased costs for climate adaptation, crumbling infrastructure, and pension obligations. There's talk of a state income tax surcharge on non-residents who own property. That's not policy, that's desperation. Kentucky, the silent collapse. Kentucky doesn't make headlines like Illinois or California, but their pension crisis is arguably worse because nobody's paying attention. Kentucky's pension system is 45% funded,
meaning for every dollar they owe, they have 45 cents. That's borderline criminal mismanagement spread over decades. They tried to fix it in 2013 with reforms that moved new workers to a different system. Didn't matter. The hole was already too deep. Last year, Kentucky dedicated $3.8 billion to pensions. That's nearly 20% of their entire state budget just to keep the lights on. And it's not enough. The unfunded liability is still growing. By 2026, Kentucky will face a choice: massively slash education and healthcare or default on pension promises to teachers, firefighters, and police. There's already a teacher shortage. Imagine what happens when you tell current teachers their retirement might not exist. The uncomfortable math. Here's the mechanism that connects all 7 states. They all made the same fundamental mistake. They promised benefits based on assumptions that never materialized. In the 1990s, states assumed pension funds would return 8% annually, forever. They built budgets and made promises around that number. The actual return over the last 20 years, about 5.5%. That gap, compounded over decades, is how you get trillion-dollar shortfalls. But it gets worse. Those returns were calculated assuming steady contributions from a growing workforce, but birth rates collapsed, immigration slowed, and remote work allowed people to live anywhere, so they left high-tax states. The whole model was built on perpetual growth, and growth stopped. Hype versus reality. You'll hear politicians from these states insist they have a plan. They don't. What they have is a deck of PowerPoint slides showing best-case scenarios if everything goes perfectly, and nobody leaves, and markets boom, and federal aid somehow continues. None of that is happening. The reality is this: these 7 states are experiencing a slow-motion bank run. The wealthy leave first because they can. Then the middle class realizes they're being asked to fund a system that no longer serves them, and they leave too. What remains is a population too poor to leave, supporting a government too broke to function. It's not a recovery story, it's managed decline. The bigger implications. Here's what keeps economists up at night. If even one of these states defaults on pension obligations, it sets a legal precedent. Other states will follow. Municipal bonds, long considered one of the safest investments in America, will be repriced overnight. That repricing will spike borrowing costs for every city and state in the country, which means less infrastructure spending, fewer services, higher taxes. And it creates a constitutional crisis. Can a state actually default? There's no legal framework, no bankruptcy court for states. It would end up in the Supreme Court, and the answer could reshape federalism itself. But the human cost is simpler and uglier. If you're a teacher in Kentucky with 25 years in, you've been promised a pension. You've paid into it every month. You've turned down higher-paying private sector jobs because of that promise. And in 2026, you might get a letter saying your pension is being cut 30%, not because you did anything wrong, because decades of politicians kicked the can down the road, and now the road has ended. So, should you leave? That depends on what you think happens next. If you believe these states will somehow find the political will to make painful cuts, raise taxes dramatically, and reform systems that have resisted reform for 30 years, then maybe you stay. If you believe that kicking the can is easier than solving the problem, and that by the time collapse becomes undeniable, it'll be too late to get a good price on your house, then you leave now. The math says these 7 states are insolvent. The only question is how long they can pretend otherwise. And pretending gets harder when the federal money runs out in September 2026. 18 months. The clock is running.